In the previous lesson, I gave you an introduction to market structure. There are two main theories, Wyckoff theory and Dow theory. Wyckoff theory has its own module that comes later because it deals with higher level concepts. Dow theory we're going to zoom in on now and discuss it because it is the most relevant to identifying a trend on any time frame and without the need for any extra analysis tools. So, what we have in market structure are two key terms that I want to cover now before we get into a deeper dive. They are break of structure, BOS, and market structure break, MSB. Put very simply, a break of structure is what you mark when the trend continues. So in an uptrend, when it makes a new high, that is called a break of structure. In a downtrend, if it makes a new low, that's a break of structure. And for a trend reversal, so when one trend ends and the next one begins, that is what you call a market structure break, MSB, and that denotes a trend reversal. Same for an uptrend and for a downtrend. So BOS, as you see on the chart here, you look at it and it's easiest for everyone to measure it on a line chart. It probably looks cleaner to you, especially if you're not very familiar with how charts work. You take the high. Whenever the line closes above that high, it is marked as a break of structure until it sets another high. And then once that high gets broken and closed through, it sets another level. These are breaks of structure. When the low, which led to the highest high, gets broken with a line closing through it, that is called a market structure break. Because as you can see, the uptrend, the Dow theory relevant trend of higher highs and higher lows, has been broken, and we've made a lower low below the previous trend. Now, looking at it on line charts is okay, but looking at it on candlestick charts is essential for trading because you need to have what's known as confirmation. So this is the very same chart, zoomed in, with the same breaks of structure marked. So here, because the candles deal with wicks as well as the closes, you want to draw it across, and whenever there is a candlestick which closes above the line, your actual confirmation is here. So you will notice that the level of breaking the structure is not the level where it is confirmed. The confirmation will usually be higher than that based upon the candle close. The reason for that is because if you look at these wicks, if you don't wait for the candle to close, you can incorrectly mark a break of structure. All of these 1, 2, 3 were incorrectly marked as breaks of structure because they were only the wick, the candle did not close there. When the candle closed through it, you then mark it as a confirmed break of structure, and in this case, continuing the uptrend. Same all the way up. When the candle closes, it's a confirmed break of structure. When the candle closes, it's a confirmed break of structure. And on the way down, when this candle closed below the red line, after it closes there, you mark it as a confirmed market structure break, denoting a trend reversal. So that's it. That's break of structure, market structure break, same for uptrend, same for downtrend. Now, in the next lesson, I will show you how to mark these, apply them, and use them on the charts to estimate trend reversals in real time.